Wednesday the 23rd. Stocks are down, bonds are up. Bit of a break from recent form. The next hour of Bloomberg Markets starts right now.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
So this is what the price action looks like. Stocks are down, had a good run recently. Bonds are up, which is certainly a break with recent form, and crude is rising and rising aggressively. So the Euro Stoxx 600 down by 0.9%. Brent crude is up by 5.5%, near session highs, 121. We're nearly at 122 now, and we've got a bit in the bond market. It could be UK 10 years. It could be UK 2 years. It's a similar picture really across the piece, across Europe. I bring up UK 10 years, of course, because we've had the spring statement from Rishi Sunak, the Chancellor of the Exchequer today. We'll come back to that in just a moment, Critty.
Yeah, a little bit of a risk-off mood stateside, Guy, when you do see the S&P 500 down just 0.5%. But this is actually good news, just given some of the selling pressure we've seen year to date. So you do see a little bit of a muted reaction. Let's see if it stays that way. You had Abigail Doolittle saying the technicals, well, they're pointing a little bit towards the green. We'll see if that holds. The 10-year yield actually, down just 3 basis points. Once again, muted volatility seems to be the story today in the stock market and the bond market. I really want to bring your attention to the dollar here, though, dollar and gold, because with all this talk about commodity shocks, you kind of have to talk about, well, how are people trading some of those geopolitical tensions, trading some of the worry? And a lot of people tend to look at the Bloomberg Dollar Index and the gold spot as kind of this idea that if both are rising together, it shows you that the market, that investors have this extra level of stress, this extra level of fear. And I think that's what you're kind of seeing today, which is interesting given that volatility is a little bit muted. We'll see if that lasts, though, Guy.
Absolutely. Which brings us into our question of the day nicely, Critty. If you're going to be selling bonds, what do you buy? Should you be selling bonds? Is the recent sell-off now reaching its end? Or actually, is there much more to come? Certainly that's the hint from the Fed. Matthew Savory, BCA Research Chief Strategist, joining us now. Matthew, thanks for your time today. I want to come on to the specific question of the day in just a moment. But first up, do you think the bond market move we've seen, this aggressive selling over the last few sessions, is an opportunity? Or do you think there's much more still to come? Do you think you should be buying the dip in bonds, I guess is where I want to start with you.
No, on a cyclical basis, so the next 12 to 24 months, we do see significantly more upside in yield. So to us, it would mean that, yeah, the bonds are technically a bit oversold right now, but I would use, in fact, any decline in yield from here to build up a bigger position to sell bond further.
Matthew, talk to us a little bit about quite literally the alternatives there. So what are the other options? Because it kind of seems like when people are looking at an investment portfolio, the primary narrative right now is what is the best hedge to inflation. On a fundamental basis, where else do you put your money?
That's very tricky right now because we've seen that the equity valuation can be justified if yields remain low. So it means that equities will likely have some trouble. So it becomes a question of what can benefit from the drivers of yield here. So what are the drivers of yield? If we think about that 12 to 24 months picture, it's about the fact that we do believe that growth will remain pretty decent in the global economy. Specifically, we're looking at a lot of capex to alleviate the energy transition away from fossil fuel. In the case of Europe, away from Russian dependency on energy. Also more fiscal spending and more capex as well to help companies deal with supply chain issues. So that's an environment in which normally we tend to see that industrials, materials, and financials are the sectors of the market where you want to be in. So that would be where I would put the money for the longer term picture. Near term, inflation.
Sorry, Matthew, what does longer term mean? What does longer term mean right now?
12 to 24 months, 12 to 18 months to be more accurate.
Okay, so the short-term picture looks like what?
So for the short-term picture, it's really is inflation fears that are driving yields higher. So the best protection, if we look at historical analysis of what's going on, has historically been the US dollar. And the US dollar looks particularly attractive today because the US economy is more insulated from the shock that is caused by energy prices. So the negative growth shock that is particularly violent in Europe with natural gas prices, which means that there is more leeway for the Fed to increase real interest rates than the ECB in the next few quarters. And that will help the US dollar that also benefits from safe haven flows.
Well, talk to us. You just mentioned the ECB. Talk to us a little bit about how that fits into the broader monetary policy narrative. You're seeing the Federal Reserve, even the BOE, on a very different path than, say, the ECB and arguably the PBOC and the BOJ. So how do you square how to invest regionally when you have essentially the major economies of the world diverging when it comes to monetary policy?
Yeah, I mean, in the near term, the environment has been tough for Europe because Europe is facing the most violent growth shock in the current environment with energy prices. And that has been reflected to a large degree in the underperformance of equity prices in Europe. But if we look on a more long-term basis, again, that 12 to 18 months horizon, what we see is an environment that actually benefits Europe independent of what the central banks are doing. Ultimately, European markets overweight value stocks, cyclicals, particularly those industrial, financials, and materials, compared to the US, where there is this overweight in tech, in healthcare, and things like that, that do not enjoy an environment where yields are rising. So yes, the economic environment is challenging for Europe. It's probably largely reflected already in relative stock prices, but the general economic environment will benefit the sectors that Europe overweights.
The industrial sector, stripping out defense, the industrial sector is facing huge challenges at the moment. Everything it consumes is getting significantly more expensive, be it energy, be it metals, be it people. The cost of labor is going up. I appreciate not as much in Europe, but industrials look like they are facing significant margin squeeze going forward from here. There is talk of rationing energy in Europe next winter. Do I want to be buying industrials in Europe if we're going to see energy rationing?
Well, that's an excellent question. When it comes to markets, ultimately, they trade not just on what's going on today, but when we are buying an asset, it's trying to think what's going to happen 6 to 12 months from now to the economic and underlying earnings picture. So at this point in time, BCA's view is that the energy crunch is essentially at its apex right now. We are in the period where it's the most difficult for Europeans to essentially shift away from Russian energy. So this is also reflected in the extreme backwardation that we see in energy markets and various measures of positioning. So yes, right now the handicap is the highest. The wall of worries for industrial is the highest. But on a go-forward basis, we do have a firm view that Brent prices will average around $90 to $95 in the second half of 2022, which means that that big handicap is likely to diminish. And in this context, where we do see more room for capex to increase, infrastructure spending to increase, then the sales of the industrial sector will perform very well. So if we take into account also the operating leverage, which is elevated, that should help profits, especially now that industrials have faced a bit of a correction.
Matthew, you brought up a very key point. The market is pricing in something that isn't happening now. It's happening 12 months down the road. Talk to us a little bit about the state of the consumer, not just in America, not just in Europe, but perhaps in China as well. When we're talking about the consumption that's going to kind of drive the global economy forward, it seems like perhaps in 12 and in 18 months, some of those pressures might come down a little bit. But it also seems like the markets aren't necessarily pricing that in, just given the recent panic. What's your take? Is there a disconnect here between what the markets are pricing and what's going to happen in 18 months down the road?
No, I don't think there's a full disconnect here, because at the end of the day, yes, the base case scenario would be that energy prices decline from here, that consumers feel better. But at the same time, there's still enormous uncertainty around this outcome, which means that there needs to be risk premia that are imputed in the price of all those assets. And we've seen it in stuff that's obviously linked to consumers, but also, as we've just talked a second ago, with industrials. So there is no full disconnect. However, as we move toward that outcome, if we do see energy prices decline because the situation ultimately, after how many months it takes, improves in Ukraine, Gulf producers increase their production, American producers do the same, then the risk premia will need to decrease. So we can tentatively try to put a little bit of capital in there, but I see that as a riskier call than the sectors that are more levered to corporate spending and infrastructure spending.
Matthew Savary of BCA Research, we thank you so much for your time and for your insight as always. Guy, it's fascinating here what Matthew really brought up, the idea that some of these kind of investments, this CapEx, well, it's going to take a very long time. He was talking about a 12 to 18 month time frame. What's going to happen in 12 to 18 months is interesting because on the one hand, you have this idea that some of these price shocks are going to come back down to earth. But then on the other hand, wasn't that the transitory narrative to begin with that has kind of been shoved into the back basically?
Yeah, and I really struggle with this idea that things are going to be easier next winter. We are going to find it very hard at this point in time to refill gas storage if Russia is not part of that process. We are going to find it very difficult when it comes to the diesel market. We are so short of diesel and we are going through diesel reserves like they're going out of fashion right now. And as a result of which, you come next winter, we're going to go into that winter significantly depleted as to where we normally are. So this idea that maybe energy prices come down, gas prices in particular come down, diesel prices come down, I don't know. At the moment, I think the near term is really going to determine that. And I'm not sure yet we have enough visibility near term on the situation in Ukraine vis-a-vis Russia to make that call as to what next winter looks like. Because at the moment, it doesn't look good.
And we certainly don't have the spare capacity or the infrastructure to make that happen before, say, the next 12 months. No. So certainly we're going to be exploring the impact of that. No better guest to talk about that with than our next one coming up. The UK's inflation rate jumps to a new 30-year high. That's putting pressure on the government to protect consumers from some of those price pressures we were just talking about. We'll talk with John Glenn, the UK's economic secretary to the Treasury. That conversation next. This is Bloomberg.
There is unusually high uncertainty around the outlook. It is too early to know the full impact of the Ukraine war on the UK economy. But their initial view, combined with high global inflation and continuing supply chain pressures, means the OBR now forecasts growth this year of 3.8%.
A significant downgrade from the 6% that the Chancellor was talking about only a little while ago. That, of course, the Chancellor of the Exchequer, Rishi Sunak, speaking a little bit earlier in the House of Commons, delivering his spring statement. Let's talk more about the inflation that the Chancellor was referring to there. We earlier today saw the data for the UK. This is February data, the headline CPI number coming through at 6.2%. Now, remember, the Bank of England expects that number to go significantly higher, up towards 8%. Some are suggesting it goes even further than that we may see double-digit inflation in the UK. RPI, which is the old measure of inflation, is already at 8%. We're at 8.2%. Now, a quarter of government debt is linked to RPI. The debt servicing cost for the UK economy is going to absolutely explode over the next year. And we are likely to see it being by far and away the fastest growing part of government expenditure. Now, this inflation number obviously has an impact back into the economy, and it's going to hit the consumer. It's going to hit the poorest hardest. It is regressive. Inflation is regressive in terms of the impact that it has on the economy. The expectation, therefore, today was that the Chancellor was going to be delivering a significant package in order to help those most in need to deal with this challenge. However, we've got this rising debt cost. Does that mean actually that the government's hands are tied, that it can do not as much as it would want or hope to, or others would hope it to in these times of stress? Well, let's bring in, to try and answer that question, John Glenn. He is the Economic Secretary to the Treasury here in the UK. John Glenn, welcome to the programme. Is that rising debt cost, higher interest rates, going to mean that this government can do less to help those most in need when it comes to this cost of living squeeze right now?
Well, I think what it means is that the extremely challenging circumstances for the economy as a whole has meant that the Chancellor has made some tough choices. And what he's announced today are some immediate interventions to help the most vulnerable in our society. He's increased the amount of money that people can hold on to. He's reduced the levy on fuel. That will take effect immediately and will mean £1,500 more money kept back for individuals who drive HGV vans, for example. What he's also done is he's looked at the thresholds by when you start paying national insurance, and he's increased that to the level that you start paying income tax, and that will be worth £330 to taxpayers. That's very significant, and of course it builds on the interventions that he made in early February, where he brought in £9.1 billion of help to people to deal with the specifics of the additional energy costs that have come in. And some of that will be coming into people's bank accounts in a couple of weeks when they get their council tax bills. Now, obviously, the uncertainty that you talk about is really important because the OBR say that fiscal headroom could be wiped out by small changes. And you've also pointed to the fact that debt servicing, the debt interest cost is also increasing. That's going to be £83 billion next year. That's £1,200 for every man, woman and child in the UK. That's a significant amount of money. So obviously that has constrained the amount of support and additional help you can give households.
John, it's Creedy in New York. Rishi Sunak said during his statement that he's keeping fiscal firepower in reserve for later this year. Can you outline some of the worst case scenarios there and what measures are being held in reserve?
Well, what he's done is he's announced some clarity in terms of the direction of travel on income tax. And we're going to reduce income tax in the UK in 2 years' time to 19p from 20p. But what he's also done is said that he's held some back in line with best practice to deal with that uncertainty in the economy, around 1% of GDP. And that's broadly in line with what previous chancellors have done to deal with the uncertainty over that trajectory of growth. He rightly said at the outset of this piece that growth predictions have been reduced from previous fiscal events by the OBR now to 3.8%. And obviously, it's really important that we ensure that we can fund everything go forward, but also have that room to make other interventions as circumstances evolve.
How can you fund things going forward? How can you say that, for instance, that 1p tax cut is fully funded when we don't know what's going to happen going forward? You've referenced uncertainty a number of times already. We have interest rates that are going higher. Why have you announced 2 years out an income tax cut that doesn't look like it's going to be fully funded? Because we don't know what is going to happen. We don't know what is going to happen with Ukraine. The Chancellor said that himself. He said it's fully funded, but we don't know what's going to happen because we don't know what the situation is in Ukraine. That strikes me as him saying, we don't know if this is fully funded.
No, it is fully funded. But in all fiscal events, and I've been part of several, there are evolving predictions of what will happen with the public finances. And what he's done is made that policy choice in the context of what we know now, but retained the flexibility in order to accommodate changes in growth trajectory and changes in the economy. And that's a sort of prudent way of dealing with the level of uncertainty, and that's what you'd expect from a responsible chancellor. But what he's prioritised is helping families, those pretty much on the lowest income, with the measures that I mentioned earlier.
John Glenn, today what we've seen is a significant cut to the growth trajectory of the UK economy and a significant acceleration in the impact that inflation is going to have. Is the UK economy now facing stagflation?
No, we're facing challenging times, as is the whole of the world economy, with grave uncertainty around what's happening in Ukraine, affecting confidence levels. The Chancellor also set out his determination to invest in human capital, in capital itself, physical capital, and also in ideas. And he'll be bringing forward incentives for investment in the budget in October to try and ensure that the conditions for growth in the economy are optimal so that we can get out of this by growing our way out of it and returning to higher levels of growth than are anticipated at the present time.
Well, John Glenn, the UK's Economic Secretary to the Treasury, we thank you so much for your time and for your insight, as always. Coming up, Fed officials are out this week backing Chair Jay Powell's call to get going on raising rates. San Francisco Fed President Mary Daly will be speaking to Bloomberg. That's ahead. This is Bloomberg. Let's get a check on the U.S. markets. Risk-off mood, still a little bit there. Bloomberg's Abigail Doolittle is tracking the moves.
Yeah, interesting and competing signals here, Kriti, because you can see overall the S&P 500 down about 0.4%. So a little bit of a break in the rally that we've had over the last several days. Of course, last week, the best week since November of 2020. And to the upside, you have Apple, one of the biggest weightings to the index, up 1.5%. I don't think on a particular reason, but that suggests risk sentiment. On the other hand, you have crude, that commodity back above 115, a bit of a headwind. So again, those mixed signals, and then bonds up just slightly with that 10-year yield down. Now, if we take a look at what's really flying on the day, and actually over the last couple of days, I mean, this is really incredible. If you bought there, you're really pretty happy. This, of course, is the Golden Dragon China Tech Index, up 53% in a little more than a week. Talk about risk sentiment, certainly there. Even as rates have been going bonkers to the upside, folks wanting in on China Tech. That's true, too, for meme stocks. Let's take another look at the meme stocks on the day. Rising, GameStop up 13%, 12.5% after rising 30% yesterday. You can see AMC and Tilray also higher. Mullen Automotive earlier today, it had been lower, but on the month, you can see it's now higher. On the month, up more than 700%. So this meme stock mania, it's been returning sort of behind the scenes here. Very, very interesting, suggesting that we may continue to see some bid for some of these growthier stocks. The VIX, take a look at this one-year chart of the VIX. Now, the VIX is very interesting because it started to come up from its bottom last June. You have this series of higher lows. Right now, that trend suggests you could see the VIX go down toward 20, maybe even a little bit below. Let's see whether or not that happens, guys. So many different moving pieces, but it does feel like even with that S&P 500 down just a little bit, it feels like we are in a risk-on mood.
Abigail, what are the technicals, though, telling us?
Well, interestingly enough, the S&P 500 yesterday closing above that 200-day moving average. From a pattern standpoint, the index is confirmed to go toward, let's call it 4,600 or so. Whether or not we see a new all-time high, that seems less likely. And of course, on bonds, this is very interesting because to see stocks go higher, you would expect bonds would continue to go down the way we've seen money from bonds going into stocks. But there's reason. I was showing a chart yesterday with the 10-year yield hitting up very strongly on peak resistance. If resistance holds there, it suggests you could see that 10-year yield go back toward 2% or lower. So it's interesting to put all these different moving pieces together. It's definitely not a traditional look at how you would look at all these different asset classes, Guy.
Abigail, thank you very much indeed. I want to come back to some headlines that are dropping onto the Bloomberg right now, which are fascinating. So a key advisor to Mario Draghi, the Italian Prime Minister, suggesting that Italy is not minded, Kriti, to pay for its gas, and Italy is a significant importer and then user of Russian gas in rubles. Earlier we heard from the Kremlin suggesting that Europe may be forced to pay in rubles, which I guess is one way of supporting the Russian currency. But I guess you do wonder whether we're finding ourselves now in a situation where Russia is engineering a turn of events where it could say, you chose not to buy our gas, not the other way around. It looks like that could be the positioning here.
Well, you know what's interesting about this is simply the way some of these payments are being made. They already negotiated with, say, India about a rupee ruble system. I wonder if they're trying to do that with some of these other countries as well.
Well, let's get the Fed's take on what is happening here. I want to turn to Bloomberg's Equality Summit. Bloomberg's Mike McKee is joined by Mary Daly. She, of course, is the San Francisco Federal Reserve President. Let's listen into Mike's questions
about things like inflation and the war that are going on actually interest a lot of people. We have a lot of concerns. Yesterday, you said in a speech that it is time to remove the accommodation we have been providing. That means marching up to neutral and looking at whether we need to go over neutral to tighten a little bit, restrict the economy to ensure that inflation comes back down. My first thought was, what song are we marching to? But my second thought is, what is neutral? How high do you have to go and how fast do you have to get there?
Well, let me say that the song, and I'm picking up on what you said, but the song we're marching to is that we have a dual mandate: price stability and full employment. And of course, with the labor market so strong, inflation is the top of everyone's mind. And so then it's about removing that accommodation. And if you think about estimates of the neutral rate, and there are a wide range of estimates, the confidence we have in any specific estimate is not very high, but I'll just use what I think more or less is a consensus estimate, which is that the real neutral rate is 50 basis points, 0.5. And expected inflation at our target is 2% on average. So that gives you a nominal neutral of 2.5. So if you think the nominal neutral is 2.5, then marching towards neutral, as you would say, or I did say, is getting the policy rate to 2.5 at least, and then being restrictive would be moving it above that. But of course, the neutral rate of interest is it's a concept. It's a star variable, as we call it, and they're easier to talk about theoretically than they are to measure. But the measurement we have suggests that, to answer your question specifically, 2.5 is sort of the neutral nominal rate that we would be aiming for. And then if we went above that, that would be restricting the economy, not just removing the accommodation.
Well, how far above it do you think you have to go? And again, how fast do you have to get there?
So let's start with how far above it we need to go. I think, my own view is that some increase in the policy rate above neutral is likely to be required, but that's down the road in 2023. And so right now, I don't think we need to be so decisional on what that looks like. We just need to be recognizing that if inflation comes down because our policy rates adjustments are affecting inflation, and because the factors that have also been pushing it up, supply chain disruptions, the weak recovery of labor supply, we get labor force participation to come back, the general settling of the economy, people start buying services and not just goods, then we might find that just a little restrictive is just right. If, of course, those factors don't materialize and inflation keeps moving up, then we're going to have to be a little more restrictive. But I don't think it's necessary to call that today, just to be assuring the American people that we're prepared to do whatever it takes to ensure that we get price stability, which clearly no one thinks we have right now.
Well, several of your colleagues have talked about front loading. Are you in that boat as well?
I actually think the SEP, the Summary of Economic Projections that we released last week, is front loading. If you think about it in historical context, the traditional way that we've done it over the last couple of decades is you raise the interest rate, you rest a meeting, you raise the interest rate, you rest a meeting. And it's really that gradual approach that was meant to see what's going on and then make adjustments. But the SEP median was 7 increases in 2022, and that suggests quite a bit of front loading on policy. And I'll remind people, if I may, that we're also going to make balance sheet adjustments, and as early as in the May meeting, but that hasn't been decided completely yet. But that's another, that's generally considered an equivalent to at least another rate hike. And then, and this is something we often don't talk about either, we're making these adjustments at the same time other central banks across the globe are making similar types of adjustments, tightening policies. So we could get a lot of tightening in financial conditions globally, and that is something we have to think about. So I do think relative to previous periods of tightening, this is quite a bit of front loading, just as the SEP has indicated.
Well, Chairman Powell said on Monday that he's open to a 50 basis point move at the next meeting, and the market is certainly taking him at his word. Are you willing to support that?
I think the data will tell us whether 50 basis points or 25 basis points in the balance sheet is the right recipe, or 50 basis points in the balance sheet. These are all the tactics of how we get the policy rate adjusted, and the data will help guide us. And so I would hate to front run those deliberations, but I will absolutely confirm what Chair Powell's confirmed for himself, which is that I have everything on the table right now. If we need to do 50 is what we'll do. If we need to do 25 in balance sheet, that's what we'll do. But the data will help us determine how much is necessary. The important thing I think everybody listening would like to know is that we're committed to moving the policy rate in alignment with what the economy needs. And right now, it doesn't need all the extraordinary support that we've been offering.
What do you think the war in Ukraine is going to do to the global and U.S. economies? We had Christopher Waller, Governor Waller, on the board say that he didn't vote for 50 basis points last time because he was unsure. But Jim Bullard told me yesterday, we can't wait to find out. We have to act now. What do you think?
So when I look at and I put a couple of risks in front of people. So the invasion of Ukraine and the ensuing difficulties. First, my heart goes out to the Ukrainian people. But if you think about the effects on the economy, that it is definitely a global headwind on the U.S. In the U.S. with the domestic economy, I see it as mostly a risk to inflation, further upward pressure on prices, gasoline. You already see it at the gas pumps, but also other commodity prices, which ultimately are inputs to goods that we are already finding high prices for. So I certainly think it is an upside risk to inflation. I factored that in, and I think it's a modest risk to growth, but not the kind that would produce anything like stagflation, because again, we're a net oil exporter right now. And so when prices rise, production in the US also increases and we get that offset on growth. But this is a big uncertainty shock. And then you also have this happening when it's clear that COVID is not completely behind us. In the US, we've been very fortunate. We feel like maybe we're moving to endemic, but they don't feel that in China right now or other parts of Asia or even in the UK. But particularly Asia, where the tolerance for COVID because the vaccination rates are low is just lockdowns, and that disrupts supply chain. So I think all of these factors push up inflation and have a limited effect on growth, but certainly it's material that we should think about these things.
Well, Dallas Fed researchers put out a paper that scared a lot of people yesterday that said if Russian oil stays off the market for the remainder of 2022 in the way that it is right now, that a global recession is almost inevitable. Do you disagree?
So I think it's too early to call that we're going to have a global recession. And I think it's too early to call that, this is, all research is a hypothetical. You're imagining what would happen, a counterfactual, if you will, that hasn't occurred yet. So I think it's useful. Our models are very useful. Our research is extremely useful in laying out the possibilities, but the probabilities don't often match up to those possibilities. And so right now, when I look out, I see a very limited chance the U.S. will fall into a recession. I do feel that the global economy will slow. How much it slows and how much people adapt to the changing conditions that we find ourselves in, I think is still uncertain. But the bottom line is that countries across the globe are facing something really important, which is inflation that's far too high for their tolerance and for their price stability goals. And we also have these risks on the horizon, which is why, I have stated that I don't think it's appropriate to, really ratchet up so quickly that we forget about the risks out there, but rather we be data dependent. We see how the data comes in and we're prepared to do whatever it takes to ensure price stability and in the wake of all of the other challenges that we have.
I suspect if I asked you if we could reach a soft landing, you would say, yes, we can. But let me put it this way. What are the odds that we can, that the Fed won't tighten too much? That seems to be a major concern on global Wall Street.
Well, certainly I'm committed to doing everything that I can and we can to achieve a soft landing. And we've got periods of history. Alan Blinder, who was the former vice chair of the Fed, is doing work on this. It shows we've had periods of history where we've had a soft landing. And so it's not unusual that we can achieve that. But what it requires is just what you said. It requires us to be diligent about getting the right amount of accommodation for the economy. But, I'll use an analogy if you'll bear with me. And it's one that I use when I try to explain policymaking to people. If you're in a car and I'm driving and you're in the back seat and you see that we need to slow down there, you hope that I'm aware and I've got my foot on the brake and I'm slowing, but you're also hoping that I'm not slamming the brake on and throwing you from the back to the front seat, because that would be disruptive. And so a smooth landing is about adjusting the policy rate as quickly as we can to get the right amount of accommodation in the economy for what the economy demands, but not doing it so abruptly that we are disruptive in the doing. And I think the disruption can come from just moving too quickly, but it can also come from imagining that there are only a few risks out there when there are really, multitude of risks. And so that's how I'm approaching it in a balanced way with commitment to get price stability. I really want every American to wake up and not think about inflation.
For those of you who are listening to this on Bloomberg Radio, this is the Bloomberg Diversity Summit, and we are speaking with Mary Daly, the president of the San Francisco Fed. Madam President, in August 2020, the Fed announced a new framework for its monetary policy. Let the economy run hot, let inflation rise a little bit before reacting so that more people can find jobs, particularly minorities and women. And this is where we transition to the diversity question. First, is that framework now junk given what's happened with inflation?
No, I actually think the framework has served us well because, the framework wasn't just about that. It didn't just say, oh, let's run the economy hot and employ as many people as possible. What it said is we have a multitude of conditions we could face. One of the conditions was the one we'd been challenged by for the decade leading up to the framework, which is after an 11-year expansion, we were not yet able to get inflation stably up to 2%, which is our target. And we know the risks of inflation below the target are also costly. They're not just inflation above the target. So the second thing we learned is that we just didn't really know. We have estimates, but we do not know what full employment is until we experience it experientially by seeing it in wages and ultimately in prices. So you put those two factors together and we say, full employment is a broad and inclusive goal, and our target for inflation is not 2% a perceived ceiling, it's 2% on average. And so those are two things that we held to. So then you roll into the pandemic, and what it allows us to say is, look, to all the consumers and businesses out there, we are committed to ensuring that inflation is 2% on average and that full employment is met. We eliminate shortfalls. And so here we are today. And we have eliminated shortfalls in employment. I think if you're a firm out there, you recognize there is not a shortfall in employment. There's a shortfall in numbers of people who want your jobs. And so that goal has been achieved. And we have inflation that's too high. But if you trace back the reasons of inflation being too high, it doesn't trace back to the framework. It traces back to supply shocks on the supply chain, the rotation of all of us to buying, exercise equipment and home improvement goods rather than partaking in vacations and other services, and the fact that we just lived through a global pandemic and we're still struggling with it. So those are things that the framework's well equipped to do because we now say full employment, we have a strong labor market, and we're committed to getting, using our tools, which we've always had. The framework didn't tie our hands, using our tools, the policy rate, the balance sheet reductions to bring inflation back to our definition of price stability. So I see that as serving us well. And importantly, the employment recovery has been broad and inclusive, and something that I think we'll look back on and say that was a success after a global pandemic.
Well, the way monetary policy works, you raise interest rates, that slows demand, which slows investment, which slows or constricts hiring. So what do you say to blacks or Hispanics or Asians or women who would say, yes, we have an inflation problem, but it's my job you're talking about?
Well, what is true is that the rates of unemployment, the rates of quits, all the things we can look at have wage growth. That's been going up most rapidly for those at the lowest part of the wage distribution. Blacks and Hispanics and women, the unemployment rates for those groups have been falling. For Asian Americans, falling, and really starting to narrow some of those gaps. In fact, we're seeing things in the labor market. I've been a student of the labor market for my entire career. We're seeing things in the labor market that we often don't see until very late in an expansion. And so the good news is we're already seeing those things. The important question for me, as I think about this from a policymaker's perspective in an equity summit, is, we have to be nimble in our policy. So right now, inflation is top of mind because inflation is a regressive tax. The very people we care a lot about in terms of equitable inclusion in the labor market are the very people who are being most ill affected by the rapid rise in prices. So these are intertwined goals. They're not trade-off goals. And intertwined goals means that full employment depends on price stability. Price stability depends on full employment. And what I tell all of the groups who you just named and anyone else who asks is that achieving one achieves both. If we do them together, we'll get an economy that's sustained. And we do know this, that for the groups that have been historically less advantaged in our economy, a sustained expansion is the best remedy to many, many of the problems that they face.
I want to broaden out the discussion of diversity now, but before I do that, I want to help familiarize some of our viewers with maybe a little bit about your story. You came from a broken family, dropped out of high school, ultimately got a GED, then went and got a bachelor's, master's, a PhD, ended up in the research department at the San Francisco Fed, then became the research director, and in 2018 became the president of the San Francisco Fed, succeeding John Williams. You're the second female president for the bank and the first openly gay woman to lead a central bank. So you know a lot about diversity, which sets the stage for a few questions here. And I want to start with diversity at the Fed. The system, not necessarily your bank, but the system has been heavily criticized for being a bastion of white males from privileged educational backgrounds. Can you diagnose the problem? How has that affected policy and ultimately Americans who are being affected by the Fed's decisions?
Well, so let me start by saying something that I hope all of us would agree to. I certainly hold this as a North Star, that we make our best policy decisions when we reflect the people we serve. So this is ultimately the public's Fed. And if we have the people around the table, and I importantly want to make a distinction between what I would call decorative diversity, where you have a lot of different people around the table, but only a few people have voice. So we have to have a diverse group of people, but we have to have a diverse group of people with voice who can help make spot problems and broker solutions and come up with ideas that create the best policy for every American. Now, the question is, why have we historically not had that kind of diversity? Why have we not represented the people we serve in terms of our research department? So let me talk about economics. Economics is a profession that if you compare us to some other of the scientific professions with the STEM professions, we actually have a poor track record in terms of diverse groups taking up and getting a PhD. And since it requires a lot of technical expertise to be in the research department of the Federal Reserve, then we've ultimately felt like, okay, we can't do better. But the truth is we can do better. And you can do better on a variety of fronts. First, you could recognize that simply having a macro or a finance degree isn't the only way you can contribute in monetary policy. I'm a microeconomist studying labor economics. And when I came to the Fed, there was a question about whether I'd ever be allowed to even go to the FOMC. And here I am. And I think I make a contribution. So I think, that proves a point that is broader than me. It proves a point that different ways of looking at things, if you're not in the traditional fields, can be helpful. But those are also fields that have more women, more minorities who partake in them. So that's one thing. The second thing is we can change the pipeline. The Federal Reserve is one of the biggest purchasers of economists in the U.S. marketplace. And we are actively working as a system to try to change the pipeline, get young people to think about PhDs or economics as a degree that they would like, go out and talk to people. Ultimately, Mike, I'll say that I've always compared it to this. Economics is a little bit like the people, I know you've all been to these houses where they invite you to their house and then they tell you how they'd like you to behave so that they feel comfortable having you there. And I want economics to be the profession that we all have been to these houses as well. People invite you to their house, they open their doors, they can't wait for you to bring your full self to it. And then they may learn something but they just want you to be who you are. And economics has not traditionally been that profession, but I know that we can be. And the Federal Reserve and all my colleagues, we're devoted to trying to make that home everybody wants to go to.
Well, it's interesting you say that because you've told a story about how in some graduate schools, many of the schools have all kinds of welcoming efforts to try to get people into the schools, and economics hasn't done that. And one of the reasons we may see fewer minorities and women is they don't feel like it's a welcoming profession and that they can advance. How do you change that?
Well, I think we have to get out there. I implore schools to do this, and some schools are doing this. But in the absence of being able to implore people to do it, we'll just do it. So, my colleagues and I are here in San Francisco, but elsewhere, we're just going to schools ourselves and talking about the value of being in economics. And we're starting, we just had an essay contest to bring in a young researcher to have that person work here with us and invest in them. Now, we're piloting a variety of these projects, but getting it to scale is the harder part, and it's going to take more people than us. But I definitely think this is possible. But what would make me very happy is if I walked onto the campus of any university in the United States and I saw gigantic welcoming signs like they have in computer science saying, "We want you. Please come to our department for a mixer." And think of all the young people of all kinds, maybe from a rural area. I didn't even come from an Ivy League school. And so, that was not very inviting for me. But boy, what if we change that equation? That would be tremendous. So I'm an optimist by nature. So I'm eager to work on these things. But I do think it's going to take more than just optimism. It's going to take intention. It's going to take changes in practices. It's going to take the idea that if we were entrepreneurs and our pay depended on it, we would create a 5-year plan and we would have deliverable improvement in 5 years. And that's the mindset I have to bring to this.
Now, you've done some studies that show this is not just the right thing to do, it's the economically prudent thing to do. I think you did a research paper that suggested that it costs the U.S. economy, this lack of diversity, about $3 trillion a year, 70 trillion since 1990. This is a lot of money.
It is a lot of money. And the reason we did this paper is that, the issues of equity and inclusion and diversity tend to, get relegated to a fairness debate or a social issue, but actually they're important for our economic fortitude, our competitiveness as a nation, the ability I think all of us want to have, which is to give the next generation a better and brighter future than the one we inherited. And if we're leaving this much talent on the table, we put a dollar amount on it. That's just putting a dollar amount on the literally millions of Americans that we leave their talents on the table. Either they have barriers that don't allow them to go into the things that they'd be best at or the things that they're most interested in, or we simply don't even employ them. They just aren't part of the labor market. And so the point of the work was to show that an inclusive economy is a productive and competitive economy that has a bigger pie that can then be divided across a variety of us. It's an evolution of that famous phrase, "We all do better when we all do better." I think this is beyond fairness. This is really about our livelihoods and our future.
I want to ask the sort of the how did you do it question, and that is that if I did a survey, I think it would be very hard to find any boss of any color who would say, "I'm not going to hire a person because they're a minority or because they're a woman," but they don't get hired. So how does that change? How did you manage to work your way up?
Well, that's a good question. And so the way I worked my way up, if you will, is that, I was really fortunate that people mentored me, sponsored me, talked to me. I've said publicly, Janet Yellen is one of my great mentors. So what did that mean? It meant that Janet was willing to sit down and have coffee with me. Or if we were at an airport waiting for a plane, because we had traveled together, she'd just start talking to me about how she did it and what she did and things to think about and things to do. And that's really just a series of conversations with a variety of people that really helped me get to where I am. And then the question is, do we want to leave that to chance? Someone once asked me, what do you take from having made it? And I said that we have a problem where we're actually, the fact that we talk about me means that it's unusual. And if it's unusual, it means we're leaving lots of other people on the table. So behind the scenes. So one of the things that we've done in San Francisco, which, we're working on this, but we're hoping that other people will join and we'll get best practices, is we launched something we call the Framework for Change. And the Framework for Change is how do we get in there the elements of that equity that actually lead to outcomes like myself so that we can scale my experience. And it's about changing processes. It's about changing posting requirements so that you have to post all the jobs. It's about giving people interview help. It's about making sure we understand that we might actually only, often choose people who look like us, whatever they are. But, someone asked me, wouldn't it be great to have 1 million of you? And I said, probably not. No, we don't want 1 million Marys. We want lots of people with diverse views, but we only can do that if we have programs, practices, and intentions that say what is true, which is we make the best policy when we have a diverse set of views and everyone has a voice.
Now, that all sounds good, but, and you know this very well, there are a lot of Republicans on Capitol Hill who say, great, but that's not the Fed's job. How do you respond to them?
So our job, which Congress gave us, is to help build a sound payment system, safe and sound payment system, a safe and sound financial system, along with other regulators, and execute the dual mandate goals of price stability and full employment to the best of our ability. And to the best of our ability, serving every American means that we have to have a diverse set of voices around the table. And if those are my inputs, then I have to be committed to ensuring that I deliver that. And delivering that means I have to be thinking about equity issues, diversity issues, inclusion issues, voice issues. And importantly, what I've learned in doing that is that these things are so material to our economy that it is absolutely squarely in our mandate. And those are the reasons why. And, I talk to various leaders of all different groups, business leaders, congressional reps, community members, and we can all align around one thing, that we understand that when you are a public servant and you serve every American, it means you have to hear from every American. So that is what I do.
Let me slice a little bit back into the Federal Reserve, and that is a question about over the past couple of years, there's been an issue with women not returning to the labor force the same way that men did after COVID. How much of that is really because of childcare or medical care for others, and how much is it maybe a secular shift in the way women think about working in the same way we had in the 1990s when so many joined the labor force?
Well, it's hard to parse out those changes in culture from changes in constraints. But one of the things that you learn early on as an economist, it's like a little thing that we are taught, is that, using culture or tastes and preferences is the last refuge of a scoundrel. And they really do teach you that. But what is meant is that, we can always ascribe what we see to differences in culture, differences in preferences, et cetera. But it often is differences in barriers, differences in constraints, differences in opportunities. And so with women, as a group, I'd rather them prove to us that they don't want to come back rather than assume that they don't want to come back. And right now, when I look at what women in particular have to
Mary Daly, the San Francisco Fed president, in conversation with Bloomberg's Mike McKee from the Bloomberg Equality Summit. You want to follow that conversation? You want to continue to follow that conversation? And it's an excellent one. You can do so on your Bloomberg. All you've got to do is go to Live Go. Kriti, the takeaway for me, she sees a very limited chance that the U.S. will suffer a recession. Actually, that wasn't the takeaway for me. The takeaway for me is, once again, what an incredible woman.
Well, that's the possible need for a 50 basis point hike at the next meeting in May. And that seems to be the headline there from that conversation.
Absolutely. As I say, you want to continue to follow Mary Daly in conversation with Bloomberg's Mike McKee. You can do so on Live Go. From Kriti and myself, this is Bloomberg.